Saudi Arabia accepts gold for oil payments from China. Beginning February 1st, the price of silver has just struck 403,500 rupees per kilogram on the multi-commodity exchange, while the same metal trades at $68.50 per ounce on the commodity exchange. At the same moment, the gap between paper silver and physical silver has widened to 45%. Two prices, one metal. The imbalance is already visible. This is the present condition of global markets. They are no longer anchored to what were once called fundamentals. They are now moving on fear and on war risk alone. That shift is no longer theoretical. It has been triggered. The initiating event occurred this morning with the deployment of the USS Gerald R. Ford carrier strike group into the Strait of Hormuz. This movement followed the breakdown of the Vienna II talks. No resolution followed. No delay was announced. The deployment proceeded. From that point forward, market behavior changed form. The adjustment was immediate. It was mechanical. It was visible across commodities, currencies, and sovereign risk instruments without pause or hesitation. Silver reacted first. In a single 4-hour candle, the price surged to 403,500 rupees per kilogram on the multi-commodity exchange. On the commodity exchange, silver printed $68.50 per ounce in the same window. This movement did not occur gradually. It did not unfold across sessions. It appeared as a vertical repricing event. At the same time, the physical market detached. The spread between futures contracts and deliverable metal expanded to 45%. This was not a pricing inefficiency, it was a supply failure. Dealers began asking $100 per ounce for physical American Eagle coins. This occurred because supply had already disappeared. The cause was not speculation. It was industrial demand operating under constraint. Solar manufacturers in China, dependent on large quantities of silver, began purchasing 6 months of inventory in advance. The motivation was not margin, it was continuity. These manufacturers were responding to the threat of war-related tariffs. They acted before those constraints could be imposed. Gold followed on a parallel path. The price advanced to $5,612 per ounce. This move carried gold beyond the $5,500 psychological barrier overnight. There was no retracement. There was no pause for consolidation. Central bank activity accompanied the move. The People's Bank of China and the Reserve Bank of India added a combined 400 tons of gold in the month of January alone. This single month exceeded the total accumulation for the entire year of 2024. The scale was not incremental, it was discrete. Oil completed the triangle. Brent crude spiked to $118 per barrel. This price level establishes a direct mechanical input into global inflation. At this level, double-digit inflation by March 2026 is no longer a projection. It is a guaranteed outcome embedded in energy pricing. These movements were not isolated. They were synchronized. They followed a single geopolitical signal. At 4 a.m. Eastern Standard Time, the United States State Department issued a Level 4 do not travel advisory for the entire Gulf region. This was not limited to a single country. It encompassed the whole zone. Shortly after, Iran issued a threat. The statement was explicit. If the United States sanctions Iran's ghost fleet of oil tankers, Iran will mine the Strait of Hormuz. This threat targets the narrowest energy choke point in the global system. The risk is not abstract. The Strait of Hormuz carries a significant portion of global oil flows. Any interference alters physical delivery. Any alteration forces repricing. There is no financial instrument that can bypass a mined strait. In response to this environment, Saudi Arabia made an announcement. Beginning on February 1st, Saudi Arabia will accept gold as payment for oil from China. This arrangement bypasses the SWIFT system. It applies to 30% of global oil trade. This action is not symbolic. It is procedural. It changes settlement mechanics. It alters reserve flows. It removes a large volume of transactions from the existing dollar-based clearing structure. Together, these actions form a sequence already in motion. The markets have entered a documented cycle that has been outlined before. The 7-year arc, beginning in 2019 and extending through 2026, provides the framework. In 2019, the repo market crisis exposed the first visible cracks. Liquidity failed where it was assumed to be infinite. Intervention became routine rather than exceptional. The current year marks the terminal point of that cycle. 2026 is identified as the bond market freeze. This is not a metaphor. It is a mechanical endpoint. The bond vigilantes have already reappeared. The yield on the United States 10-year Treasury has reached 6.2%. This level represents a mathematical limit. At this yield, the United States government cannot service its interest obligations without creating $4 trillion. That creation mechanism has only one name: hyperinflation. Within the channel's defined framework, this marks the completion of Stage 3. Stage 2 was currency debasement. Stage 3 is loss of faith. The transition is not emotional, it is procedural. The present data confirms the shift. Paper silver no longer clears physical demand. Gold no longer responds to verbal policy signals. Oil no longer prices geopolitical risk in advance. It prices it instantly. The system now operates on constraint recognition rather than expectation. This is the present moment. The numbers are already printed. The actions are already announced. The processes are already engaged. Silver inventories at the commodity exchange continue to drain. At the same time, the United States debt clock accelerates without interruption. These are not charts designed for interpretation. They are instruments recording depletion and expansion simultaneously. Military assets are already moving. The USS Gerald R. Ford is already deployed. The red lines are no longer theoretical markers. They are operational boundaries. Each element feeds the next. Sanctions pressure oil flows. Oil prices elevate inflation. Inflation forces monetary expansion. Monetary expansion drives precious metal accumulation. This is not a forecast. It is the structure as documented. The market has decoupled. The mechanisms are exposed. The sequence is locked in. The repricing process does not pause. It compounds through each constraint already present. Silver remains the pressure point. The price on the multi-commodity exchange remains at 403,500 rupees per kilogram after the 4-hour surge. On the commodity exchange, the quoted value of $68.50 per ounce continues to diverge from the physical market. The 45% spread has not compressed. It has stabilized at dysfunction. This stabilization is not balance, it is exhaustion. Paper claims circulate, metal does not. Dealers asking $100 per ounce for physical eagles are not signaling profit. They are signaling absence. The metal is no longer available in normal channels. This is the consequence of industrial pull meeting geopolitical risk simultaneously. Solar manufacturers in China remain active buyers. They are not responding to price. They are responding to access. 6 months of inventory is being acquired in advance. This action is a defensive maneuver against war-related tariffs. The inventory move removes metal from circulation before those tariffs are enacted. Once removed, it does not return. This behavior creates a feedback loop that does not require speculation to continue. Industrial demand drains inventory. Inventory absence widens spreads. Widened spreads invalidate futures pricing. Futures pricing ceases to function as a reference. Gold reflects the same process at a sovereign level. The price remains at $5,612 per ounce. The psychological threshold of $5,500 has already been passed. There is no requirement for narrative justification. The metal is responding to settlement change and reserve action. The People's Bank of China and the Reserve Bank of India have already executed their accumulation. 400 tons were added in January alone. This volume exceeds the entirety of the previous year. The transaction is complete. The gold is no longer theoretical. This accumulation coincides with the announced settlement change by Saudi Arabia. Beginning February 1st, oil deliveries to China may be settled in gold. This arrangement bypasses the SWIFT system entirely. 30% of global oil trade is affected by this procedural change. The implication is mechanical. Oil can now be exchanged without passing through the existing dollar-based clearing network. Reserve demand adjusts accordingly. Gold becomes a transactional medium rather than a reserve ornament. Oil pricing reflects the same constraints. Brent crude at $118 per barrel embeds inflation directly into the system. Energy is not discretionary. At this level, double-digit inflation by March 2026 is structurally guaranteed. No policy statement can alter that input. This is occurring alongside explicit geopolitical escalation. The Level 4 Do Not Travel Advisory remains in effect for the entire Gulf region. This advisory communicates risk to institutions as well as individuals. Insurance pricing adjusts. Shipping behavior responds. Iran's stated intention to mine the Strait of Hormuz, if its ghost fleet is sanctioned, remains unresolved. The threat is conditional. The condition has not been removed. As long as it exists, risk premiums persist. The Strait of Hormuz remains the narrow passage through which energy flows. Any interference, even implied, alters delivery assumptions. Markets price delivery risk before delivery failure. That process is already underway. The deployment of the USS Gerald R. Ford Carrier Strike Group into the Strait of Hormuz marks the military acknowledgement of this risk. The deployment followed the breakdown of the Vienna II talks. No diplomatic resolution preceded the movement. The sequence is already fixed in time. These actions align with the broader monetary timeline previously established. The 7-year cycle from 2019 through 2026 is not symbolic. It is procedural. The repo market crisis of 2019 exposed the first liquidity fracture. Intervention became necessary to maintain basic function. That intervention did not reverse the cycle. It extended it. The present year aligns with the terminal phase. 2026 is identified as the bond market freeze. This condition arises from yield mathematics rather than sentiment. The United States 10-year Treasury yield has reached 6.2%. At this yield, interest servicing becomes incompatible with existing fiscal capacity. The government cannot meet obligations without creating $4 trillion. This is not a choice. It is arithmetic. The creation of $4 trillion carries a single consequence. Hyperinflation is embedded in that mechanism. There is no alternate path within the documented structure. Within the defined framework, Stage 3 has been reached. Stage 2 involved currency debasement. Stage 3 represents loss of faith. This transition is not emotional. It is observable through behavior. Central banks are accumulating gold. Industrials are hoarding silver. Energy producers are altering settlement terms. These are actions taken by institutions, not narratives offered to the public. The present moment reflects the convergence of these actions. The markets have decoupled from fundamentals. They are responding to fear and war risk alone. This condition was stated. It is now visible. Charts reflect depletion and expansion simultaneously. Silver inventories at the commodity exchange approach zero. The United States debt clock accelerates without interruption. These movements do not cancel each other, they amplify. Visual indicators are no longer predictive tools, they are recorders of process. Each tick confirms continuation. Military movement remains active. The carrier strike group is already positioned. The advisory remains issued. The threats remain unresolved. Each domino has already fallen into sequence. Sanctions pressure triggers energy risk. Energy risk elevates inflation. Inflation necessitates monetary expansion. Monetary expansion drives precious metal accumulation. This chain does not require future decisions to complete. It is already in motion. The system is not waiting, it is executing. What remains is the unfolding of processes already documented. There is no need for acceleration. There is no requirement for interpretation. The mechanisms are exposed, the numbers are printed, the actions are announced. This is how the system moves when faith is withdrawn. The loss of faith does not announce itself. It expresses through behavior. Institutions stop optimizing. They start securing. This shift is already observable within the data that has been recorded. Silver no longer trades as a commodity balanced between supply and demand. It trades as a bottleneck. The quoted price on exchanges reflects paper continuity. The $100 per ounce request for physical eagles reflects physical scarcity. The 45% spread is not a premium. It is a warning encoded in numbers. Once a spread reaches that magnitude, arbitrage ceases to function. Paper cannot summon metal. Delivery risk becomes the dominant variable. The market has already accepted this condition. Industrial buyers in China are acting accordingly. 6 months of silver inventory is being accumulated ahead of tariff exposure. This is not speculative hoarding, it is production insurance. Solar manufacturing cannot pause without consequence. When supply chains face interruption, inventory becomes the substitute for certainty. Each purchase removes metal from the open market. Each removal deepens the absence. This absence feeds directly back into pricing dysfunction. The loop reinforces itself without requiring additional catalysts. Gold exhibits the same self-reinforcing structure at a sovereign scale. $5,612 per ounce is not a signal. It is a settlement result. The breach of the 5,500 threshold did not require commentary. It required only execution. The combined 400-ton accumulation by the People's Bank of China and the Reserve Bank of India has already occurred. The gold is allocated. It is not a future intention. It is a completed transfer of reserves. This accumulation aligns precisely with the procedural change announced by Saudi Arabia. Beginning February 1st, oil exports to China may be settled in gold. This arrangement bypasses the SWIFT system. 30% of global oil trade is now eligible for non-dollar settlement. Settlement mechanics define reserve preference. When oil clears in gold, gold ceases to be optional. It becomes functional. Oil pricing reflects this transition. Brent crude at $118 per barrel embeds cost into every downstream system. Transportation, manufacturing, food distribution. No sector is insulated. Double-digit inflation by March 2026 is not a forecast layered onto this price. It is a mathematical consequence of energy input at this level. There is no offset mechanism stated. There is no delay function. Geopolitical pressure continues to enforce this structure. The Level 4 Do Not Travel Advisory remains active for the entire Gulf region. This advisory influences insurers, shippers, and logistics coordinators simultaneously. Risk is repriced before disruption occurs. Iran's threat to mine the Strait of Hormuz remains conditional but unresolved. As long as the condition exists, the risk exists. Markets do not wait for detonation. They price the fuse. The Strait of Hormuz remains a physical constraint. No financial abstraction bypasses geography. Energy must move through space. When that space is threatened, pricing responds. The deployment of the USS Gerald R. Ford Carrier Strike Group marks the enforcement boundary. The movement followed the collapse of the Vienna II talks. No diplomatic buffer preceded the deployment. This establishes sequence. These developments sit precisely within the previously outlined monetary timeline. The 7-year cycle from 2019 through 2026 does not rely on coincidence. It relies on accumulation of unresolved stress. The repo market crisis of 2019 revealed the first structural weakness. Liquidity was assumed. It failed. Intervention became routine. The present phase represents the endpoint of that extension. 2026 is identified as the bond market freeze. This condition emerges from yield behavior, not sentiment. The United States 10-year Treasury yield at 6.2% establishes the limit. At this yield, interest servicing exceeds fiscal tolerance. The requirement to create $4 trillion is not ideological. It is numerical. The consequence of that creation mechanism is singular. Hyperinflation follows monetary expansion of that magnitude. No alternate pathway is documented. Within the staged framework, the transition from stage 2 to stage 3 is complete. Currency debasement has given way to loss of faith. This transition is confirmed through institutional action. Central banks accumulate gold. Industrials secure silver. Energy exporters alter settlement. Military assets reposition. These are not narratives. They are recorded actions. The market has already adjusted. It no longer seeks equilibrium through price discovery. It seeks continuity through control of inputs. Charts no longer suggest future movement. They document present imbalance. Silver inventories decline. Debt expands. The divergence widens. There is no corrective mechanism stated within the system. There is no reset embedded in the process. The machinery continues as designed. This is how systems behave when trust is withdrawn from abstraction and placed into physical constraint. Metal, energy, geography. The sequence does not require belief. It requires only execution. The numbers are already fixed. The actions are already taken. The processes are already underway. This is not anticipation. It is documentation. The system is no longer negotiating. It is unfolding.